This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Chris Younger, Managing Director at Class 6 Partners. Class 6 Partners provides investment banking and financial advisory services to middle market businesses and entrepreneurs in Colorado and across the U.S. The principals of Class 6 Partners have completed hundreds of middle market transactions and strategic advisory engagements. And by using a disciplined process and extensive research, Class 6 Partners is able to provide you with the experience and judgment necessary to complete your transaction. Chris, thank you for joining us.
Hall, thanks for having me, and thanks for doing what you're doing for entrepreneurs out there. I'm sure they appreciate it.
Great. Well, so tell us about your background before you started investing in early stage companies.
Yeah. So I've had a little bit of an eclectic background. My wife calls it career ADD, but I started out as an attorney. Don't hold that against me. I'm fully recovered, been through the 12 steps, and every once in a while I have a relapse, but started out as an attorney in Silicon Valley, a firm called Wilson Sonsini, and worked with startups and young companies doing private financings, and then did some public offering work. Then I left there. I decided that law and I were not a great fit. And then I went to work for an investor group where I helped them develop a consolidation strategy in the communications industry. And so we went out and acquired, so I was the deal guy. We went out and acquired about 27 companies over a couple year period. So it was a lot of activity in a very short period of time. And we built that company. We got it over $1 billion in revenues. And ultimately I became the president and chief operating officer of that business. So my reward for doing all those deals was I had to integrate them, which I think took some height away from me. I used to be a lot taller and probably took some years off my life. So, but in any event, we integrated the business and dealt with 9/11 and a recession, and then we sold it to Avaya, which is a communications company. And then after that, I actually tried to retire. I spent a couple years doing some investing, and after a little while, my wife told me I needed to find a hobby. And so my partner and I started our investment bank back in 2005. And through that, we've represented a lot of different companies and have, worked with lots of founders, lots of entrepreneurs. And, for better or for worse, we've seen, I think, a lot of the bad movies that occur and some good ones as well. So it's been a really, really fun ride.
Great. So what excites you right now?
With all the activity that's happening after COVID, I'm really optimistic, and I was optimistic at the beginning of COVID that, the level of cooperation across the world of pretty much all relevant scientists that would have something to do with developing treatments or vaccines, that work has, made incredible advances in such a short period of time. The fastest vaccine we've ever developed, by a factor of 4, I think. And the other thing that has been really encouraging, and we get to see this every day, is how adaptable entrepreneurs are. I think they're going to lead us out of COVID. They're going to lead us out of, whatever economic challenges any of our communities have. And it's because they can act quickly, they can react quickly. They have this ability to be really nimble. And so I'm really enthusiastic about what we're seeing from entrepreneurs. And then add on to that, there's just a lot of capital in the market. Ignore the stimulus, right, that is being sent out, which will, be in the hands of consumers. I think savings rates in the United States are at an all-time high, but the amount of private capital that's available out there is kind of awe-inspiring. And I think that'll be great for private capital markets.
Great. Well, you see lots of startups and lots of investors. What's your advice for people investing in startups out there? What do you tell them to do before they write that first check?
That's a great piece of advice. Obviously, and I think a lot of investors know this, but kind of get to know the team and be prepared to support that team. You can't expect to invest in a young company and just abandon them or leave them to their own devices. I'm assuming a lot of your listeners are angel investors that have experience operating and growing businesses. And so the the knowledge that you accumulate, over 20 or 30 years of working in this sector, you want to be able to pass that on to these young teams that are, that aren't as experienced, but have a lot of energy. I also think that, every business has kind of discoverable risks in it. And so be prepared to kind of dive in, kind of understand them, be able to help the team address them. And then I think the final piece of advice that I would give is, you have to understand that owners or an entrepreneur is going to look at risk in their business fundamentally differently than an outside investor would. They are going to be more comfortable with the risks. They're going to probably see fewer risks and less risk in their business. And as a result, the opposite of perceived risk is more value. They're likely going to see their business as more valuable maybe than an outside investor would.
Well, great. And then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out for that fundraise?
That's a great question, Hall. I think it's almost the flip, right? Understand that investors are going to see and evaluate risk in your business a lot differently than you do. And so getting objective feedback about, hey, what is it that an outsider is going to see in your business, and being, prepared to address those, objections in that sales process is going to be really important. Being transparent with your investors as to, I think the very best entrepreneurs are not oblivious to the risks in their business, but they've thought about them. They're part of their business plan. They understand and have a strategy for how to mitigate those risks. And so I think it's really just getting an objective assessment of your own business so that you're prepared to talk with folks who are just going to see your business differently. And the final piece of advice I would give is, when you take on an investor, particularly for a young business, that fit with that investor is really important. These are going to be folks that you're going to share lots of information with. You're going to have lots of debates with, and you want to make sure that they are going to be good to work with. High integrity. Ideally, they're fun to talk to. Ideally, they're really smart and have lots of experience. But get a list of questions together to help you objectively evaluate that fit. Don't get necessarily attached to the highest valuation that's being put on your company, but pay particular attention to, hey, who's this person that's going to be your partner over the next 3 or 4 years?
Well, great. Well, let's talk about the state of investing in startups. How do you see the industry evolving?
Another good question. I think what we're seeing is there's capital leaving public markets and coming into private markets. One of the things that I mentioned at the beginning of the show was there's a lot of capital out there. And when you have interest rates as low as they are, public market valuations as high as they are, it's natural to see capital flow from, the lower return environments in the public markets to higher return environments in the private markets. And so we're seeing that there's a lot of capital there. And it's not just equity capital. We're also seeing lots of private debt capital. There are a lot of credit funds out there that are more aggressive than your traditional lenders in providing debt capital. Now, as a result of having all this capital, and this is good for your entrepreneur listeners, valuations are near historic highs. There's the deals that we're doing, it's as high as we've seen them in terms of what investors are willing to value companies at, which is terrific. And I think the final thing is, as you think about, in particular, debt capital, if any of your listeners is contemplating that, while it's available, it's relatively inexpensive, you want to be pretty careful to make sure that you don't take on so much debt that becomes a hamstring for growth. And so while equity capital may be more expensive, particularly for a young business, it's definitely more flexible, which sometimes is more important than the cost of capital, just because of what that business needs to get done over the next several years.
Great. Well, what is the biggest change you think we'll see in, say, the next 3 to 5 years in this space?
I think the number of players in the market, there are new funds getting created every week. I think the amount of capital, right, is to the extent that public markets continue to be highly valued, we're going to see more capital coming into the private markets, which likely will lead to increasing valuations. In our particular market, the availability of debt capital has a big impact on overall deal valuations. And we're seeing debt that's pretty flexible, pretty inexpensive, and pretty available. And so I would expect valuations to continue to increase. I also think, and we're seeing this in all the deals that we work on, when you have more capital coming into the market and the valuations are higher, those expectations from the investment community are going to be higher. What that means is they're going to be doing a lot more diligence. In the deals that we work on, we see most institutional investors, when they're putting capital into a business or acquiring a business, they're investing $250,000, $500,000, $750,000 with advisors, lawyers, accountants, consultants, other folks that can help them do the due diligence that's required to make sure that they're not making a mistake. And so for your entrepreneur clients that are raising capital, or maybe they're going to exit at some point, you've got to be ready for that level of diligence. I liken it to the 3 worst medical exams you've ever had all at the same time. I mean, it is very invasive, and it is really difficult to get through without a certain amount of pain. So you can't wing that as an entrepreneur. You've got to be ready and prepared for that. On the flip side, the growth story for these businesses, right? When valuations get to be that aggressive, you've got to have a really well considered and thought out and defensible growth strategy. And that you've got to be able to have not just the story, but the backup behind the story to be able to convince somebody that, yes, what we're anticipating in terms of our growth is doable, it's achievable, it's not a high jump, and we believe that we can get there. And you've got to be in a position to be able to support that with numbers, which is the language that investors speak.
Great. Well, let's talk about your investment thesis. What is your investment thesis, and what's your criteria for funding startups?
So when we think about owners or entrepreneurs, the best ones are going to anticipate that level of risk in their business, and they're going to address those risks proactively, even if that means they've got to make more investment now to generate returns later. And so you, as an entrepreneur, again, you want to have looked at your business just like an investor would, well ahead of when you're going to have that conversation. And I also think, like we talked about, the best owners are going to have a really clear, understandable, defensible growth strategy that they've thought long and hard about, and hopefully have tested in the market. We see a lot of entrepreneurs that have great growth stories, but if you don't have that evidence behind it to support it and make that growth strategy kind of more believable, it really, as good as they may sound to the entrepreneur, it'll ring hollow to those investors if you haven't really thought about it carefully.
Great. Can you mention 1 or 2 startups that fit your thesis?
We're seeing a number of SaaS businesses that have been very thoughtful about what it takes to acquire a customer, what's the long-term value or the lifetime value of that customer. They understand the significance of having really, really high incremental gross margins. And they also, because their revenue model is recurring, sometimes contracted, if they've been disciplined about retention, hopefully reducing customer churn, those businesses are some of the most attractive that we see in the market today, and are capturing, almost unbelievable valuations. And that's just because those businesses, when you think about the cash flow that they're going to generate, that cash flow is a lot more predictable. Those businesses, they've got a good proven plan. And for businesses that we see in the market, as those SaaS businesses start to get beyond 5 million in revenues, or ARR, annual recurring revenue, and up to 10 million, they start to get more attractive to institutional investors. There are some magic numbers for them, but those, you've got to, as a SaaS business, right, there are some key metrics that we just talked about that they've got to be thoughtful about. And, but those businesses are doing really, really well in this market.
Great. Well, let's talk about the challenges in the space. What are the challenges in the space for the startup? What do you see your startup struggling with most?
So we spent a lot of time talking to CEOs, and I would say the number one regret when we talk to CEOs that have been there and done that is they failed to build their team early enough. And that's true for a lot of different reasons. They may be concerned about cost. They may have some control issues. They may believe that there's no one that could do the job as well as they can. But that notion of investing in your team early, and if you're investing in quality team members, the businesses that we see that have done that grow much faster, more predictably, and with less drama. I also think a lot of entrepreneurs don't think through customer dynamics as well as they should. How reliable is that customer base? Is that customer a repeat customer, a recurring customer? Is it a project customer? Really having a clear understanding of what it takes to get that customer and then what they're worth to that business is something that I think entrepreneurs can really benefit from. I also think that, and this really relates to the failure to build a team early enough, is a lot of companies, if your revenues are less than 30 million or so, it's really likely that there are going to be some key elements of that business that are way too dependent on the owner. The owner may be the principal salesperson. The owner may be the principal product development person. The owner may be the one that's in charge of operations. And failing to reduce that dependence of the business on the owner has a big impact on valuation. And it also has a big impact on how scalable that business can be over the long term. And then as we talked about, I think a lot of entrepreneurs, particularly when they are going to talk to investors, a lot of them have just failed to think objectively about how somebody else is going to look at their business. And as a result, they may be unprepared for the objections that they're going to hear from the investor community. And the best entrepreneurs, right, have thought about it, have thought about the objections, and will have good, well thought out answers to that. So those are the kind of the biggest challenges that we see for entrepreneurs.
And then on the other side of that table, what are the challenges you see the investor facing in today's market?
Well, when you have as much capital as there is, these deals are highly, highly competitive. Some of the deals that we're working on are getting 20, 25 bids. And so that's a lot of competition for deals. And for investors, it's not inexpensive to review a company in detail, to enough detail to be able to make a bid. And so, that takes a lot of time for them. And conversely, with that much competition, valuations are really high. And so, that sometimes requires that these investors use too much debt in their financing structures, which can and will have an impact on those businesses down the road, particularly if they have operating challenges. Mm-hmm. And then I think the final piece that we see is, given the level of activity, a lot of these investors are getting spread really thin in terms of the number of companies that they can legitimately oversee and contribute to. And particularly for young startups, investors, ideally, right, you're going to be there as a sounding board and be able to help them navigate the inevitable challenges that they're going to have. And so if you're doing that for 3 or 4 companies, that's manageable. If you're doing that for 10 or 15, it's really not manageable. And unfortunately, it does a disservice to the entrepreneur.
And so you see a lot of applications and sectors out there. If you had to pick 1 or 2 that you think are good immediate opportunities for investors to pursue, what do you put at the top of the list today?
Yeah, SaaS, as I mentioned, is a really attractive vertical to be focused on, particularly when, again, that lifetime value to cost of the acquisition of the customer is good, when the margins are high, when churn is low, and when growth is good. Those are really attractive businesses. We are also starting to see, I think COVID was a good reminder that having the majority of our manufacturing offshore probably does not put our supply chains in this country on a good footing. And so we're starting to see investment dollars coming back and manufacturing coming back into the US. There was I think for a long, long period of time, we saw an exodus of manufacturing, whether it was to Asia or Mexico. But now we're starting to see some of that come back, particularly as it relates to, pharmaceuticals and protective gear and that type of thing that I think was a big wake-up call here in the US. And then the final industry that has also been, I think, as COVID has highlighted how attractive these businesses are, is these direct-to-consumer product companies. They've established an online presence. They're not selling through retail. They probably are not even selling through Amazon, but they've established their own online presence. So they have a direct relationship with those customers. The margins generally are much, much higher than if they're having to go through retail or certainly through Amazon. We see gross margins in a lot of those businesses that are over 50%. Those businesses are really attractive and, are starting to attract a lot of investment dollars.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
You've asked a lot of great questions, Hall. I would say, again, for for an entrepreneur, make sure you're planning ahead. Again, the best deals that we see is when the business owner has clear intentions, they've planned well ahead of that goal, and then they've executed really well. I've talked a lot in our session here about understanding kind of the levels and types of risk in your business to be able to communicate intelligently and thoughtfully with your investors. We use a tool, you can get it on our website, but we're happy to make it available to your listeners. It's called Copilot, and we use that to assess a business, where it allows us to, it's basically a questionnaire that a business owner or an entrepreneur fills out. And then it tells us when we get the report, and we'll make that report available. It basically tells you, hey, what risks in my business should I be particularly concerned about? And what are the strategies for trying to address that risk? And so it's, like I said, you can access it by emailing me, or you can access it through our website. Just reference this podcast when you do so.
Great. Well, how best for listeners to get back in touch with you?
The best way, you can access us through our website, which is www.class6partners, so classvipartners.com. Or you can certainly email me. It's Chris, CHRAS, at class6partners.com, and welcome any inquiries for folks that need help.
Great. We'll put those in the show notes, and want to thank you for joining us today, and hope to have you back for a follow-up soon.
Oh, thanks so much, Hall, and thanks again for what you're doing for entrepreneurs.
Great.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.